Okay, well, good afternoon, guys. Thank you, Rolly. That's probably one of the most professional and best introductions I've ever had on probably the 700 or 800 webinars that I've presented over the years, so thanks for that. Okay, guys, well, I'm going to go over my approach, my interpretation of the market. So, as Rolly said, I've done quite a lot in the markets. I'll go through that and just put my own little spin on that, and then I'll go through really how I came to develop my strategies. Some interesting techniques revolving all the kind of indicators you will have heard of, things like Fibonacci, Bollinger Bands, things that are really, really integral to creating good, meaningful technical charts. So, as really rightly said, I'm a professional trader, but I've also been a risk manager at Revco, and I manage the largest trading floor in London at Schneider's. I am currently the Chief Market Strategist of IntraTrade.com, have been for 4 years now, and I also run their education. I own TraderMaker, and I also have an official add-on, which is TraderMaker Pro. I have my own charts to run an MT4, which is, again, what I'm representing today, my iView charts. I'm also currently in discussions with Tradable to develop some apps, so lots of interesting things coming my way. The rough guide to trading is finished. It's with the editors, and that should be published in January, so I'm told. It takes a little bit longer than I thought, the old writing a book process, but it was good fun, and again, it's a very, very insightful journey through my trading career and how you can use my techniques within the markets. Again, I was nominated for the Forex Street Best Awards of 2014. I've been working with FX Street for 4 years now. So as guests as a presenting an educational name, I've been around for quite some time now. I'll read you a risk warning again, just when it comes to just general kind of disclosures. You have to do things these days. And remember that spread betting, CFD trading, carry highly risk or capital with the possibility of losing more than initial investment. These products that I trade might be suitable for all investors not intended for people of the age of 18. Please ensure you're fully aware of the risks involved and necessary to seek independent financial advice. Content of this webinar is posted over the moderator, which is Steve Ruffley. Content does not constitute financial investment or tax advice. I recommend you discuss your specific requirements with an independent financial advisor prior to entering any bet. And during this session, your trading results are following my trade ideas or the use of my software and products. Okay, sorry about that, but I have to read the disclaimer. When it comes to trading, I think there's a few popular misconceptions. Now, the first one is that professional traders always make money. They don't. You're taught as a very at an early age as a trader that you're going to have to accept losses, take them on the chin. I think people take trading quite personally sometimes, and that really is with the retail beginner traders, inexperienced retail traders, but also professional traders over. It's just like anything. It's like playing a round of golf. You will have that bad shot. You will have that bogey. You'll drop some shots. You'll be in the bunker. That's part of life. You've got to take it on the chin. You've got to accept it as being part of the game and get on with it. People get too consumed thinking there's a holy grail out there and they should always be making money trading. There isn't. Trading, some you will win, some you will lose. All you have to do is get the percentages on your side. And once you do that and understand that losing trades are just a part of trading, you're going to be a lot happier as a trader and also much more successful. Another misconception, and again, there'll be people with different opinions on this, but the markets are controlled and manipulated. To some extent, there is manipulation. And to some extent, there are spikes in the markets that retail traders can do very little about. I have different reasons behind this and different thoughts. The first one is I'm not trying to say that there isn't big traders out there. There aren't institutions that know the rules of the game and use it for their benefit. What I'm trying to say is that you can't control these things. If you get preoccupied thinking that there's somebody out there taking your money and there's somebody that knows more than you, then that's going to take up your valuable time, your valuable energy, okay? And that's going to detract from your trading. Don't focus on what you can't control in trading, okay? What you have to do is accept that that is part of the way the markets are, accept that's what is part of the trading game, and get on with it. Okay, so I'm not sitting here saying there aren't bankers out there making money off retail traders. There are. I've done it. But what you have to understand is you can't control that. So you have to keep that positive mentality and control what you can. And that's your trading strategy, your entry, your exit, and risk. The markets, well, that's what we have to be involved in if we want to trade. Okay, you can't take it personally. I think another misconception is that people think you have to hold positions for a long period of time to make money. No, don't get me wrong. If you hold over a day, week, or month, obviously the market's got more room to move. But I would say in these markets, with this volatility, you have every opportunity to make money out of trades. The Fed decision last night was a perfect example. I traded that live on FX Street and I made 80 pips. Yep, traded some Eurodollar, bought the bottom, S&P, traded the bottom as it sold off aggressively, bought some more on the way down, and then it shot back up. Okay, so I probably held that trade for less than 4 minutes. okay? And I made 80 ticks. So that is the ability we have within these volatile markets to make money, but you have to be prepared, and you have to have your technical side in play and understand the fundamentals. I believe markets move 80% of the time technically and 20% of the time fundamentally, but that 20% fundamental will just make the markets move and interact with these levels a lot quicker. It's all part of the same thing. You can never discount the fundamentals, okay? Trading's a good way to get rich quick. Well, I think anybody who's traded for any length of time knows that isn't the case. And again, I would say that, you know, trading's all about being realistic. If you start off with a, you know, $1,000 account and expect to be a millionaire by the end of the year, just isn't going to happen. So you have to manage your expectations. And everyone reads the charts the same. I know this for a fact is not the same. I can look at this exact same chart as another trader and see a completely different picture. What I would say is that trading's the same for 99% of the people out there. We all really have access to the same information these days. You know, there's just so much good quality technical charts that you can use that are free, and there's so many good sources of good information for the fundamentals. You know, trusted sites like Bloomberg, Reuters, and you have all the Twitter feeds that, you know, make access to what was, you know, very, very exclusive information available at a tweet, at a touch. Again, it's the credibility on Twitter that lets it down a little bit, but it doesn't really matter, does it? So why is it so difficult to make money from trading? Well, there's no real mystery when it comes to trading. You buy low and you sell high. It's really that easy. I would say that trading is probably one of the most easy activities you'll do. It's the click of a button. It's as soon as you click that button, everything becomes difficult. You start to contradict yourself with your technicals, your fundamentals. It really is like no other job, no other activity I've taken up. The reason why trading becomes difficult is because there just is too much information. And I would say that generally people don't have a sustainable strategy. You know, they jump from technical analysis to technical analysis. They think there's that holy grail. You start using, you know, out there techniques like Ichimoku clouds. Then you start using, you know, irregular moving averages. The trouble is people just become, you know, on that mindset. And that's a human condition that if they just keep learning and they know more, they'll be better traders. That isn't the case. Sometimes the less you know and the less things you do, but do them well, make you more money. Now, having taught well over 1,000 traders, I know this is the case. I've taken people back to basics, you know, strip down the chart, strip down their understanding, and once you get that control back, that's when you become a better trader. Trading is really all about understanding yourself as well. You know, everybody likes to, that's why people that are involved in the trading for any length of time like to, you know, develop EAs and trading strategies and software and automation. So they take the emotion out of it. What you're trying to do as a human being is strip back that fear, strip back that emotion, and just do what you know is right. Trading's not about being right. It's about being right at the right time. We can all look at a chart in the morning and say it's going to go up, this market's going to go down, but doesn't mean you're going to make money. That's what makes trading truly frustrating. But again, what I'm trying to put across today is when you look at my approach, my techniques, we're trying to get that solid foundation of something that we can use on all the different products, all the different time frames. Then we've got a base, and all we then do is just tweak it to make the best of what we've got. As I said, most traders don't really have a sustainable strategy. Many traders do not write a trading plan down. Many traders just open the charts, open their trading platform, and just trade. Now, if you don't do any kind of preparation in any task, then you're not really going to be at the top of your game. So I'd say that any tiny bit of plan you're trying to achieve is very important, even if you set yourself some basic goals. And do not fall into the trap of your goal being, I want to make money today. That's not a goal. It's not quantifiable. Just set yourself a reasonable target. I want to make 3 winning trades. I want to make $100 from 3 trades today. You know, set yourself something that is both achievable and, you know, means something to you. There's absolutely no point in setting goals that are unrealistic. By this time next year, I'm going to be a millionaire. Are you? Very unlikely. Not with trading a small account. Okay? So what we're trying to do really is go back when I'm talking about charts and I'm talking about my theories, is understand the self-fulfilling prophecy. Now, the self-fulfilling prophecy in technical analysis is that it works because people trade the markets. So if more people are using a 20-day moving average than not, it has to have some meaning in the markets. So what I try and do is try and turn trading on its head. Everybody out there is looking for their system, the holy grail, okay? Now, if you're trading a unique system that only you know, then nobody else really is kind of trading that way, are they? So they're not bringing into the factor and they're not bringing into the markets that self-fulfilling prophecy. So what I do is turning on its head. So I know people use Bollinger Bands. I know people use moving averages. I know people use Fibonacci. So if you understand what the market is trying to achieve and all the tools that they use in the markets, you're doing one or two things. You're not trading on that. But what you're doing is once you understand the framework of what people use in the technical analysis and the rules of the game, then you can understand what the big players, the big traders and institutions will do. You'll understand where fear will come into the market. Again, the reason why the majority of retail traders get stopped out is because they run a 1% risk. Now, why do they run a 1% risk? Because that's what they're taught. If you Google risk-reward ratios for trading, you will get the same answer all the time. That you should use 1% of your trading account as each trade stop. Okay? Now, we all know in these volatile markets, that's practically impossible. But you know, again, if you're trading off something like RSI and we're overbought at 70, 75, 80, the market has the ability to push it up that extra 5, 6 points on the RSI and get you out of your 1% stop. All the market is ever doing is looking for fear and pushing markets, to the absolute extremes to get that retail trader out. And then the market does exactly what you think. The whole point of my analysis and my kind of thoughts on this is if you had unlimited money, unlimited time and computers, and you were sat there with $1 billion account, would you trade the same way? Would you make it fair? No. Life isn't fair. Trading's not fair. But what you have to understand is that everybody knows the rules of the game. So 3 non-farm payrolls ago, expected figure was 211, came out 288. What do? Well, you buy the S&P on a 288 figure. That's a great non-farm payroll. But what does the market do? It sells off 10, 15, 25, 30, 50 ticks. 50 ticks down. Every retail trader is out. I traded this live in front of 100 people. I bought like everybody else, held on, bought some more at the bottom and said, we know what's going to happen now. All the retail are out. Institution comes in, the market takes over, and we make a new high. 15 minutes, we've made a new high. That's just experience, guys, and that's just understanding the rules of the game. If you understand the rules of the game, understand they can be exploited. Yeah, and the people with the biggest pockets will generally win. But you have to factor that 1% understanding into your trading. Don't fall into the trap of just being a standard retail trader. Understand and build that in. So okay, what are my strategies? Well, I've traded for so long, there are just certain techniques that work. Now, I've got the benefit of having spent hundreds of thousands of pounds getting things wrong. I'm like everybody else. I thought, as a young guy at 21, I was going to take on the markets, be a counter trend trader. Yeah, I don't have to listen to the rules. I'll do it Steve Ruffley's way. That worked for about 2 days. And then for the next 2 months, I lost a fortune. Hey, these things happen. So I talked to some smarter guys, some guys enlightened me to how the markets work. And many things that I've told you right now, you'll think to yourself, well, yeah, I kind of knew that, but I never really did anything about it. And it's like I had that kind of, light bulb moment. So having had the benefit of risk managing, some top city traders, people with £1 million accounts, and again, just been involved with the markets for so long, I've got to see so many different techniques. And what I try and do is, again, turn it back on its head and understand what everyone's trying to achieve, then put my own unique spin on it, and then that's my interaction with the market. So I know what the market's trying to achieve, I know how I want to interact with the markets, and then I use my strategies to fit them all together. The 4 elements that gave me the basis to understand charts in the markets, and also the sentiment, how it's driven, all revolves around using the right kind of time frames. Okay. Now, people ask me, one of the most common questions is, what time frames do you use to trade, Steve? Well, I use them all. People don't like that answer. But what I would say is, you have to understand what's happening on the monthly chart. Big close is very, very significant. So is a weekly. So is a daily. So I would say generally for my intraday trading, I'm generally looking at the daily with kind of monthly and weekly lines of support, highs and lows, resistance, but then always bringing that into my intraday charts and looking at the hourly signals. Hourly for me are the absolute rock solid best way to get them good quality signals. So I look at my daily for general direction, my hourly for signals, and 15-minute for entry. If you put 3 charts of the same product side by side, then you're going to get a good idea what the market's trying to achieve. The main indicators that I use are generally a combination of RSI, moving average, Bollinger Bands. A big part of that is Fibonacci, and generally they all revolve around the hourly chart. Now, I've written 2 different independent pieces of software, and Bollinger Bands and Fibonacci featuring all of them. All the trade calls that I give for Bloomberg, Reuters, the Financial Times will have an element of Fibonacci. It, for me, is just one of the most sustainable and one of the most understandable tools out there. Big problem with Fibonacci is people don't know how to use it. They don't know how to use it consistently. There's 2 ways, and again, I'll go through this in the presentation, but it's essentially you're looking for overextended moves or candles, and again, a solid directional move that has to follow certain criteria when it comes back. So very much like the Elliott wave, you'll see An Elliott wave has stage 1, 2, 3, the biggest one, 4, 5, then 3 correctional waves. You have to have them rules. What I don't like about Elliott wave is that you don't know it's an Elliott wave until it is an Elliott wave. With Fibonacci, you know where you stand. You take it from one extreme to the other. Then the criteria, the percentage retracement levels are set in stone. So they're always going to be an understandable target. So candlesticks, Bollinger Bands, and moving averages, RSI, what they do for me is they automatically transform a chart. If you're looking at a standard MetaTrader chart, that's how it looks. You don't get any information.
Hi, I'm Alan Luckman, options market.
You don't really understand what the market's trying to achieve. As in Bollinger Bands, moving average, RSI, and candlesticks, you immediately get a better picture. You can understand the market's hit a low. We've come within the Bollinger Bands, the red line's the moving average. We've crossed with the Bollinger Band moving average midpoint, and all of a sudden the market's finding support. We're above 50 in the RSI, so we've come from an oversold territory to overbought. Therefore, across a moving up RSI, that's a good option to buy. And there we go. You've made yourself 20, 30, 40, 50 pips for doing very, very, very little work there. So just by using and again, your chart doesn't look overly complicated. Many a time I've seen on Facebook people with the 6 screens and the laptop on the side and charts and or market profiles and all that kind of stuff. The rule is if you don't look at it at least every 15 minutes, it shouldn't be on your charts. I've gone to absolute pains, absolute extreme lengths to make my charts as streamlined as possible. So if something, a line or a particular indicator is hit or indicates to me there's something to do, then I do something. If I don't, then it's taken off my chart. You get too little time to make decisions in the trading market, so everything on your charts has to count. So again, by adding these 4 indicators, you're able to interpret the charts much more objectively. So we have used the 14-period moving average as a short-term support. So we can see quite clearly the red line acts as support. Then it crosses the 20-period Bollinger Band moving average. So the RSI is above 50, level of 70. Remember, overbought 70 level is interpretation. The RSI is an oscillator. The reason why it's called an oscillator is because it moves between 0 and 100. If it wasn't and didn't have a range, then it'd be an indicator. So that's the difference. So other indicators, other oscillators will move between 0 and 100 and 0 and 1, like the D-marker indicator, for instance. But RSI, generally, the market expectation is that between 30 and 70 is the normal range. That's not to say that the market and the RSI can't push to 80, 90. I've even seen it as high as 98. And again, that just indicates the market is telling you what it wants to do, the direction, what the actual sentiment is. So once we've rejected the lower area of the Bollinger Band and moving average, then again we can see the market wants to move up. All this space here in the blue box is telling us the market doesn't want to sell down to here. There are more buyers than sellers. The cross, the support, market then moves up. Okay, so it doesn't really have to be overcomplicated to understand what the people in the market are trying to achieve. So again, the candles are showing lower tails, rejecting the sell side. That's why you need to have candles rather than bars. Candles are very, very important. So again, lots of rejection on the low side, tails showing you that when the market wants to push down, it can't close in these hourly candles towards the lows. So every time, if you flick onto the S&P or the FTSE, again, this is a technique I was quoted in Reuters probably 2 or 3 times over the last 6 months. If you look at a daily close on the S&P or the FTSE, you see that long wick on the daily candles rejecting a move to the low side, and probably 70% of daily candles will close within 50% of that body. So every time we've tried to push down in the indices in general, we haven't been able to close towards the lows and the market's moved up. So just dip buying off the dailies and the next daily open, you can probably have made about 2,000 or 3,000 ticks over the last 6 months just using that simple technique. And that's just candlesticks alone. Okay. So if we're looking at the charts in this way, I'm able to see that from a technical perspective, cable, the pound against the dollar, is looking pretty bullish on the H1 time frame. So we can flick to the 15-minute chart to find a perfect entry, or realistically, what we're trying to do is just buy low and sell high. Okay. Now, with them 4 indicators, we've made things pretty simple. Again, the temptation is to kind of put more indicators on to get more information, and all of a sudden you start to do that and you start to overcomplicate the charts. Okay. So now this is the easiest part of trading, forming an opinion. The key to successful intraday trading is to make money from that opinion. We're not doing it for the fun of it. We all like to be right, but at the end of the day, we want to see that profit. How often have you as a trader been right on a direction and still lost money on a trade? As I say, trading is not about being right. It's about being right at the right time. Beginner traders, experienced traders make the same mistake. Okay, there's no prizes for getting the direction of the market right time and time again and losing money. Okay, all that is a road to madness. So you have to take into account the fundamentals as well. 80-20 rule, that's how I look at it. Markets move 80% technically, 20% fundamentally. That 20% fundamental, be it news, be it figures, will speed up the technical interaction of the charts. It's all part of the same thing. Do not fall into the category of being a quant or think you only have to trade technically and fade out fundamental news. You will get burned one time so badly, you will probably give up trading. I've seen it too many times. Why discount news? Why discount the fundamentals? Why discount people's opinions? People trade markets. Understand it's 20%, 1/5, okay? So trading for me is all about probability, okay? The majority of the key indicators I know traders are going to look at are bullish. So the self-fulfilling prophecy should mean that markets go up, again, referring back to that chart. So however, in my experience, markets tend to function in a different way. So they're usually going to do the opposite in the short term, okay, before they then fulfill the self-fulfilling prophecy. So again, that's what I'm trying to instill in you, that we all can look at a chart, put on them to well, it's bullish, so I'll just buy, I'll be fine. But the second you buy, the market drops down 10, 15, 20 ticks, you're out the trade. And it's like, oh, right, well, why did that happen? Then all of a sudden the market gains some traction, goes bullish, you miss it because you've been burnt, and then the market does exactly what you thought. So what I'm trying to tell you is markets are so efficient at the way they function that they're always in real time, trading and understanding what the average and what the mentality of the majority of traders are thinking. So you have to be one step ahead. And that's why, again, your 1% risk isn't going to work in these markets. You need to be running 2, 3, 4% risk at some point. And that means you've got to trade less times. So you have to wait. One of the biggest hurdles that helps me get over these kind of problems and help traders progress is to average. So instead of trading a 5 lot every time you trade a 1 lot. Start with minimal size and then build over prices. So build over a position, build a position over a number of prices to average in. So if you buy at a price and the market goes down 10 ticks, you're actually thinking, well, that's good. I'm going to buy some more down here at a better price. As the market pushes the retail traders out, then we find some good support and then the market goes up. So if you can build a position over a number of prices, you're then automatically building yourself a bigger, better position in the market, but also managing your stop in a different way. A finite stop is that. How many times have you been stopped out to the pip, then the market has gone in the direction you thought? Okay, every 177 people in this room, if you've traded for more than 6 months, there will be, I can say, 99% of us will experience that. The market gets us out to the pip almost, and then does exactly what you think. Now that again is the market functioning in its most raw, most efficient way. Getting retail traders, getting people out with fear, and then doing exactly what the market thinks. So once I identified the market was bullish, I looked for the most logical place in the market where the market's going to find support and resistance. Now, the markets have memories because people have memories. People love to go through the charts and say, well, this was a low back in 2012, so that must be a significant point. Now, for me, the significant point has to be real time. If you go too far back in the charts, what I like to do is use the Fibonacci's on the hourlies. So what I'm doing is very, very simple. But if you do it in the right way and consistently, you're going to build up a strategy. So my biggest and most successful way of interpreting markets is around Fibonacci. So I know this market's bullish. Okay, I know it's bullish. So what I try and do is figure out where the market's been and where it can go. This to me is what I class as a strong directional move. The market goes from the high to the low. We see a big amount of red candles closing towards the bottoms. It looks very negative. The candles are a lot bigger than the previous candle that have traded, and it's gone in one direction. It's gone from a high to a low. It hasn't made a new high, hasn't made a new low. That in time on them hourlies is a significant trading piece of information. So all I do simply is take the high to the low to draw my Fibonacci lines. My basic rule of Fibonacci is once I've found a good directional move, 80% of the time, a strong directional move will retrace to 50%. That's an 80% edge. Okay, now that is from, I don't backtest things because what's the point? I'm telling you that from live years of trading the markets for over a decade. 80% of the time, when I've used these kind of simple Fibonacci points as points of interest, targets, entry point, they've worked 80% of the time. Okay, 20% of the time they don't. So you manage your risk and you get out for a manageable loss. As I said to you when I first started, this is trading. You're going to have to take a loss on the chin. So what I'm saying to you is 8% of the time, the strong directional move down will retrace to 50%. So as the market doesn't make new lows, I'm looking to buy on these upper fib levels, 23.6, 38.2, until it gets back to the 50%. So 80% of the time, if this market doesn't make a new low, we're going to hit that 50%. So all you have to do is get involved. Buy some lows. Okay, you can buy some lows down here. You can buy that 23.6% to the 50. Okay, it's not going to make you a millionaire, but it's 20, 30 solid ticks banked with very, very little downside risk. Okay, use your Bollinger Band moving average cross. Use your 23.6 as an entry. Average back in at 38.2. Profit out of the 50. The likelihood is if we hold above that 50%, we go to make new highs. So you can build a longer term strategy around it. But I mean, I can't say, I can't think of offhand a tool that is any more reliable than Fibonacci for understanding where the market's been. This in the past. This has happened. So anything down here, we don't know, do we? We don't know what's going to happen after this red box. But what I do know is that's been a high, that's been a low. Okay, so that is a significant period of trading time. That means something to me. So once we're out of that red box, then that is the future. But I know as the fibs start to act as support, that 50% is a magnet, an absolute magnet for the markets to get back to. So Fibonacci, again, hopefully, everybody trading here has experienced Fibonacci retracements. So the kind of theory behind it is nothing new. So again, we're going back to Leonardo Fibonacci in his 12,002 book. This stuff is really, really old. And again, it's in Indian mathematics as well. It's something, there's nothing new in maths, nothing new in trading. So the fact is, this thing has been around for so long, means it has significant retracement, but it's part of the same calculations. So the Fibonacci numbers, again, interesting Fibonacci fact, your forearm is the same size as your foot based upon Fibonacci dimensions of a human body. So just try that now. Put your foot against your forearm, same size. Fibonacci in action, guys. Okay, so Fibonacci in the markets is certainly nothing new, and mathematics and understanding, interpreting data is nothing new. Fibonacci for me, again, I just wanted to prove that it's something that's been around for a long time. Now, I Googled this fact. I'll never Google anything again in this presentation. Everything is from my own trading and 10 years of charting. So my basic Fibonacci philosophy. Now, this is my kind of cornerstone that I start to build my strategies around. So Fibonacci is self-fulfilling as a technical analysis tool. Once I've identified a significant directional move, okay, and that can be, as I showed you in that last chart, a directional number of candles, or an overextended candle, one candle that stands out in the chart. Again, I'll go through that a little bit later on, but anything, the trading action before or after one individual candle, will be something you can do Fibonacci on. Generally, when I trade non-farm payrolls, I'll do a Fibonacci on the initial spike on the first 5-minute candle. Then we trade a continuation or reversal pattern based upon the Fibonacci criteria. Very, very simple. But I would say my basic rock solid mantra about Fibonacci is that 80% of the time, a market will retrace to that 50% level after you've identified the right kind of move. If you haven't identified the right kind of move, then obviously that's the 20%. You won't get that self-fulfilling prophecy. But if you pick the right move and use Fibonacci in the right way, that's an 80% edge. So why? Well, the quicker the directional moves happen, the more people are going to be wrong and caught in long or short positions. So again, when we see that volatility we're experiencing in the markets right now, it's not just that people are right and making money, it's people are wrong. So if you have an individual, if the average trading candle is 20 ticks, then you see an 80 tick candle out of nowhere, people are wrong. So they're going to be out of the wrong side and going to have to get out of the trades. But people average, people do many different things when they see these things. So the fact of the matter is the Fibonacci principles and boundaries will bring it back to parity in that 50% because the market's going to make profit, people are going to lose, and that's just how these things work. The other main kind of cornerstone is that what goes up will come down, vice versa. Nothing goes up in a straight line, it never does. So even if you see the strongest trend, if you put the S&P on a monthly chart now, that's probably one of the strongest trends you're going to see. Them candles are in a very, very, very steep upward angle, much steeper than the 45 general degree rule of a good technical trend, much steeper than that. So what goes up will come down. And I'm telling you now, when these indices come down, they're going to go down quickly and aggressively. I don't think we're at the top yet. Again, I'm still expecting the FTSE to reach 7,000. Again, the DAX hit 10,000, S&P hit 10,000, 2,000. Dow, making new highs. Nasdaq very, very strong. So I still think, there's a lot more upside room in the markets. And until we start really ending quantitative easing in the US, which is going to happen next month, and starting raising UK in the Western world, like in the UK, first quarter 2015, that's when things are going to, be hard. But right now, the indices are high for the simple reason it's the most efficient place for capital. Would you put your money in Greek government debt or Google shares? Google shares. Okay, I happen to have some extremely wealthy clients, billionaires in fact, and I know how these people work. They're not looking for a massive return, they're just looking for safety. So again, where they're going to put it, somewhere where it's safe, big blue chips. Okay. So old time frame trading is another cornerstone of how I build up my trading strategies and how I interpret the markets. So what I always do is when I'm looking at any kind of chart, if you've got any kind of time at the end, I might just go through a quick demonstration on my charts. But you start on the monthlies because the monthly highs, the monthly lows are just a point in time. So in the monthly that this is the low, this is the high, do a Fibonacci, suddenly you get a pivot point, that 50%. Then you move that framework onto the weeklies, onto the dailies, and then you get a better interaction, a better idea of how you can trade this. So you start to say, well, okay, well, that we've seen that big bull move, we've hit the 50% retracement in the monthly charts. Okay, this is just Brent. So Brent, inelastic demand. Are we going to stop using oil anytime soon? No, I don't think so. So that's some fundamentals. Technically, rejection, big rejection on the monthly. So I'm thinking, well, we hold above this 50%, then I'm going to start buying and see some highs. You bring that into your weeklies, bring that into your monthlies. All of a sudden, you're buying into strength because we're trading, much more towards normal intraday, terms here because this is previous information. All of a sudden, you're buying some lows and making some money. So again, the example is we're using 107.03 as a key level where the market will bounce. Okay. So what we're trying to do is understand what happened in the past and then bring that into future trading. So again, taking these key levels, the 50%, 107.03, 38.2, 61.8, you're building a framework on the highest time frame you want point. Use your monthly charts because that still has some relevance with the fundamentals and how the market's really trading now. So we can see the highs and lows and the blue boxes here, but really the market's found value here, hasn't it? Okay, here and here. So you could even draw your Fibonacci's from the value points here too. You don't have to do it from the highs to the lows, and that will bring them fibs into a much more condensed, much more condensed view of the overall time frame. Because again, these big spikes are what you see when the market's rejecting. Okay, but this is real value where you see the candles close. So anyway, I've taken the Fibonacci from the high to the low because that's generally what I do. So that 50% level now ripples through the charts. You see it rippling through, acting as support resistance on the weeklies and on the dailies, support resistance. So when we finally start to hold above it significantly, market breaks up, comes back down. It's a technical move. Not a fundamental break. So the market breaks up, tests back down, closes above that 50%, then you buy. Stay above it, and we're going to make new highs. Easy, isn't it? Easy. Trading's as easy as that. Now, obviously, I could pick any example and make it work perfectly. That's unfortunately that's a traders and a trading presenters, forte. We find examples in the past and we make it work. I can tell you right now, I can show you on a live chart how that works. Okay, because I use it every day and I understand it. If you go into a chart now and you take a significant high or low from a reasonable time frame and then filter it through, put it down to an hourly chart, you will see the fib lines have some interaction with your hourly chart. Okay, it's all part of the same information. Hours make up days, days make up weeks, weeks make up months. It works the other way around. So many people don't hold positions overnight. So again, the monthly chart seems to be irrelevant to them. But again, using it for a framework, using it for absolutes. I don't trade off monthly charts, but I trade off the lines, the levels. Again, the same with the weekly and dailies. I don't want to hold overnight positions. Many people don't. It's money for me to get my hands on, isn't it? So I don't need to hold overnight positions. I don't need the stress. So what we're trying to do is find the intraday highs and lows and extremes and exploit that and trade and make money. Okay, so how I trade all time frames, again, I take them significant points of interest from the weekly, monthly, daily points. And that Fibonacci was an easy example with the monthlies, but maybe I'll take a Fibonacci of key points on the weekly, a Fibonacci key points on the daily. So maybe I take 3 50% key levels on the monthly, weekly, and daily and transpose them lines onto my hourlies. Again, it's still another way of getting a framework. hourly and 15 minutes are what I use for intraday trading decisions. So what we do is you take all that significant interest from the higher monthly, weekly, and daily points. Maybe it can be Fibonacci, they can be straight line, points of attraction on a monthly, weekly, daily chart, and I take them across and put them onto an intraday chart, onto your hourly and 15-minute. So all of a sudden you've got, a monthly Fibonacci level. All of a sudden you've got a framework on your hourly and 15-minute charts, so you know what's going to happen. Hold above, support, support, support. We get out at 1-1. We get 111 spot 24. We get out of the high because that is a point of attraction based upon previous weekly, points of interest. So again, building that framework is very, very easy. Now, of course, it's quite time consuming. That's why I developed iView charts. It takes all my logic, all my understanding of the higher time frame points of interest and puts them on any time frame I want. Sounds like common sense, but I tell you, the amount of traders that I've taught and then said these ideas, and it's like a lightning bolt going off. It's like, wow, Steve, that's amazing. Everyone should trade that way. I know the majority of people do. So all you have to do is understand the framework of what's happened in the past, put it onto your intraday charts, and use it as a framework. Again, using the RSI, Bollinger Bands, and Fibonacci, you can then use them for a more defined entry point. But once you know the boundaries of the market and what the people in the market are thinking, you've got the framework so you know when people are being manipulated and broke, and you know more importantly when to get in than when to get out. No point leaving money on the table, guys, in these markets. If you don't have a defined exit point, you can be losing 20, 30, 40% of your profit in a matter of minutes and seconds, okay, because the markets are so quick to bounce off these levels. So again, when you bring that kind of information and sentiment into the intraday trading arena, then you have a clearer picture. Markets have memories, so take that memory, take the memory of a weekly chart and put it onto your hourlies, take the memory of a daily chart and put it onto your charts. I mean, you can do this in many different ways. The Fibonacci for me is a scientific one. It's highs and lows and points of interest, so I put the 50 day, weeks, and months. But you can do that from plain light of sight. You can do an underlying trend line for a monthly and put it and see how that interacts on an hourly chart. All these things are part of the same, bigger picture. Like I said, all the hourlies make up days, days make up weeks, weeks make up months. So it's all part of the same thing. And that's the same for any product. FX, indices, commodities, it's all the same. When you're looking at technical analysis, there's many different ways to interpret it, but there's only really one way to kind of do it right, and that's to understand what's happened in the past, which is your higher time frames, and use that on your intraday. Okay. So the other way I use Fibonacci and my kind of sentiment rules is a bit more intraday, and that's overextended markets, overextended moves. So we can see in this particular example, the market's moving down, but what we're trying to identify is what the significant trading periods are, okay? And they are overextended candles. So my H1 hourly candle or even a 15-minute can be really, really good. It can be really good technically and also fundamentally because the market's told you what it's done and it's there in the past. So when you identify something out of the ordinary, and again, I class it as an overextended candle or overextended move, I don't know what else to call it, but if it's something out of the ordinary and I know it's out of the ordinary, I can do something with it. So there's 3 examples here of candles that I know are overextended. Now, you're already going to see where I'm going to go with this. Once you've identified this and you draw your fib from the high to the low, that's hit the 50%. I'll tell you now. This one here, okay, the up move, is certainly got back to the 50% and carried on a down move. This down move here, I'm almost positive that's got back to the 50%. So what you're trying to do is figure out what is out of the ordinary on intraday trading and then try and use that to predict the future. Yeah. So remember, you have to identify an overextended move or else it won't work. Be clear on the highs and lows of that move. And again, it's always helpful if we don't make new highs or new lows. But again, it's not essential. And understand the overall trend. Which this, again, in this market is down. So you're always trying to sell that 50% or sell high. So 80% of the time, an overextended move will retrace to 50%. I told you that at the beginning of the presentation. This is just an interpretation intraday. So the key to know is what an overextended candle looks like and where the highs and lows are for you to calculate your Fibonacci's. Once you've identified this, you're always going to find, support with the low. Again, trade back to that 50% retracement level. Remember, once you've found a good fib sequence in the markets, you can use it in the future. Again, you can. The first example we showed was this low to this high. So the 50% is here. 80% of the time, overextended move will trade to 50%. Okay, we tried to get squeezed out. This is an absolute prime example of retail traders getting squeezed out. Okay, we're thinking we've held up, we've not making a really significant low. We're finding support, getting above that 23.6. So I'm going to go long to 50%. Bang, market takes it all the way down, makes a new low, gets all the retail traders, probably some professional traders out too, but then closes. Thank you very much. Above that 23.6. Okay, retail squeezed out. Goodbye. What we're going to do now? We're going to do exactly what you thought. We're going to go to the 50%. Bang. Okay, market moves up, finds eventual support on the 23.6, then gets that 50%. So again, it's an 80%. It's an 80%, theory, but doesn't mean you're going to make money every time. Again, even I would probably have got stopped out of this trade. But then again, you have to have the confidence to get back in, buy back at the 23.6. Market tries to do it again, but closes on the 38.2 and gets to the 50. So remember, there's no guaranteed strategy, but it's interpretation. If you're brave, you'd say, okay, the market's moving down here, you get out. Okay, let it close, then you buy the next candle open. Yeah, then you buy some more here and you get out the 50%. So you make your loss back probably. But again, it's understanding that you're not right. Okay, you're right in the overall direction, but at this point in time, if you're trading this candle, you're wrong. So you have to get out. That's trading, I'm afraid. Okay, you might do exactly what you thought, but again, be aware of the market. Not manipulation, I don't ever want to use that word, but understand the market functioning very, very efficiently, knowing that 50% is such a key. And again, when you go through the markets, look how that 50% works again. Big overextended move, but then the market fails to make a new high here, comes all the way down. Close below that 50%, market continues down. Yeah, yet again, market then again, more strong candles come into play, hitting these key fib levels, again, using them as support and resistance, market then going on to make new lows. Okay, so again, you can identify a move here and trade it all the way through the charts. So the 80% edge. So although the green area on this particular example is the trigger, the idea is the momentum for the move starts and ends in the red areas. Okay, so we can see the market again sells down here, but this is the areas really where the extremes of the market are. So what we're looking for is the market to tip its hat and tell us we've hit the extremes of the market, then come back into a tradable area. So really we see the fake outs here where the market has got out plenty of traders because it's just too strong and aggressive. But when it closes, it's a complete indecision candle and it closes above the 23.6. Again, just tying in exactly all the things we know with this down move and this Fibonacci. And again, the market goes to the 50%. So what we're trying to say is that sometimes as a trader, it's not as safe to get in early. Okay, sometimes it's harder. What you have to do is let the market, give you every chance to get in and not get stopped out. So realistically, until we close above this 23.6, which isn't till 1, 2, 3, 4, 5, 6 hours worth of trading. Yeah, not until it closes within them boundaries do we get in. So if we get in any time early, we think it's a really good trade this. Yeah, really good trade, going to get to 50%, bang, everybody's out, lost money. But if we get involved here, when we close above the 23.6, we don't actually get below it, market then moves up and we get to that 50%. So again, sometimes waiting and being more patient for them closes, especially on the hourlies, gives you that safety net. So again, this trade, when we buy the 23.6 to the 50, is only 11.3 pip winner. Okay, but you take no offside position and you get out, relatively easily for that 50% level. So if you want a significantly stronger trade, wait for them closes above the fib levels. Don't try and preempt it and get in early. Okay, really good tip. So an example of that entire down move here on a 15-minute chart, you can see how the market breaks down and uses these fib levels, okay? So once we break down that 50% and we can see the overextended levels in the fib, so the 161, 268 and 423 down here, you would see these are really good levels. So once we close below that 50%, all we're really doing is looking for shorts, okay? Shorts, so we find that there's good support, yeah, go back up to the 100, resistance, sell back down. Okay, individual candles showing rejection, sell back down. Where's the next point of attraction? 161, below that, 261. And I guarantee if we carry on below, we're going to get to the 423. So again, it's using your time frames from the higher time frames, but also using your smaller time frames to give you that view. So if you just sold every high here, you'd still be making money, okay, on the 15-minute charts. So again, use whatever you want and whatever suits your trading style. So the third example is the 50% the second time around. So in this example, what we're looking for is that 50% again to have some relevance in future trading. So the fib again takes into account this down move. So there's low to the high. So what we see in this green area is the market telling us we've got a rejection. So the bottom of a downtrend, we see this hammer reversal pattern or shooting star, depending on what you want to call it. Market then moves a little bit lower, okay, in these candles, but then eventually when the market doesn't make a fresh low, double within that 23.6, that's when the action starts to happen. So once we've closed in this action area here between the 23.6 and 38.2, looking for the market to get back to that 50%, which it does. And then it hovers, comes back down again all the way to that 50%. But look, this is where it becomes interesting once again. We can't make a new low. I mean, there's still more bulls than bears, getting into that initial bear move that we see. So we see the 38.2, a nice rejection of the market trying to move low and close above it. So again, our key is to get to that 50%. And if we hold above that 50%, we should make a new high, okay, based upon this previous fib. Get above the 50%, indecision, bang, break the 61.8, go on to make a new high. So again, not an exact science. And again, you'll have to use interpretation. But if you're using Fibonacci in its broadest tool, again, you're always looking for that 50% to be an attraction. The way up, the way down, the way back up. Okay, so it's all based upon this piece of information we know. The market really wanted to aggressively sell off and did. It rejected it here and said that, right, that's enough. That's the absolute low. Market makes 2 attempts to significantly hold below it and doesn't. So once we were in that 23.6% safety net, 38.2, 50, don't make a new high this time. That's fine, but we don't make a new low here. Hold within the 38.2, moving up the fibs. 50 then is the next point of major attraction above the 61.8. As long as we hold above that, we're making a new high from here. Okay, so that's the 50% second time around Fibonacci view. Okay, guys, so all my theories and all my ideas are all in my software, my iView charts. Again, it automates it so you don't have to think about it. Every day in any product, because it's based on technical analysis and previous information, then it doesn't matter if it's forex or indices, stocks, say commodities. It works on previous data, and again, that's what makes it quite unique as a product. And again, these are all original ideas based upon what I know works 80% of the time. So as I said, guys, I've presented over 550 webinars. It's probably more like 700 now. I've done 100 live trades, 42 consecutive non-farm payrolls. I've only ever lost twice. Okay, so that's my credibility. Want to Google Steve Ruffley? Google me. My education is free. I don't charge for the education. You want my time, my software, you have to pay for it. That's the way it goes. I've been rabbiting on now, I'm afraid, for 50 minutes. Sorry about that. But I'll just take some questions if there's anything you'd like to ask. Okay, Dilip's asking, on monthly, weekly, daily charts, what time frames do you use to draw the fibs? Well, I mean, again, Dilip, what I try and do is I try and keep the data relevant. So I'll only really go back a year in monthly data, because you go too far back, you're taking out the sentiment of the market. So I would say that, just take a good significant high and low on a monthly, weekly, daily chart and try not to go too far back in the charts. I'd say a year, 18 months is as far as you ever want to go back when you're using technical analysis. What else have we got here? Any other questions here, guys? What's been your experience with the market profile? Okay, Steve, good question. I used the market profile as many people did back in the day in the kind of mid to late 90s. And that was very good when markets were trending because it generates a bell curve. But markets aren't really kind of generating bell curves right now. We're kind of going very, very volatile and going from highs to lows. And that's why Fibonacci is a much better tool than the market profile. The market profile is pretty much old technology, I would say, and it's very good in ranging markets, but with markets so susceptible to volatility, change, fundamental information, it doesn't really kind of lend itself to the theory of a market finding value. I mean, the markets obviously do find value, but the more to the highs and the lows and not to the midpoint, to the bell curve. So I think market profile has been and gone, I'm afraid. So it's things like point and figure. Point and figure, actually, no, it hasn't. Because I used point and figure back in the day for breakouts, and I think breakout trading's, again, quite an interesting thing. Again, I think markets, do go very, very high, very, very low, and then consolidate, and then a point and figure is probably a little bit better sometimes for taking the emotion out and just giving a pure breakout signal. So yeah, not all the old techniques are not relevant these days. Again, everything runs in cycles. You know, again, people didn't use candlesticks, 10 years ago. They were all about the bars. So again, who will know what the future brings? Maybe market profile will come back, but I would say it has very little relevance in modern markets right now. What's the most common time frame for drawing Fibonacci? Ben, absolutely the 1 hour. The 1 hour, yeah, on an extended candle or an extended move is where I use my Fibonacci. Tie that Fibonacci in with your Bollinger Bands, highs and lows. You're going to have a really strong way of interpreting the markets, Ben. So hourly, 100%. Good question. Okay, guys, any other questions, any other thoughts? And I guess I've got 8 minutes. So if you want, guys, I'll just do it. Okay. I'll just put a chart up and I'll show you Fibonacci in action. So let's take something like pound against the dollar. Pound against the dollar, blank chart. So if we want to go and understand what the market's trying to frame, highest time frame monthly. So we can see back to, again, I'll contradict myself here a little bit, but just to illustrate Fibonacci and what institutional traders will look at, you go back to the last significant move. Well, that's back to 2007. So obviously a lot longer than the year 18 months, but I don't think anyone can deny that this is a significant down move. So we want to find value, okay, go from the high to the low. Well, there we go, it's 50%. Yeah, so we didn't reach that. So everyone's saying because of the Scottish vote that Scotland might go independent, that the market's selling off because of that fear. That's absolute rubbish. The market's selling off because institutional traders are getting out of longs. Yeah, we all know, I knew 2 years ago, the UK was going to be first to move on interest rates. That would bring more strength into the pound. So we hit these lows in the fib lines here. Okay, well, the market, again, finds support here. So this is where your institutional traders are buying the pound. Buying the pound, anticipating that markets, rates are going to go up, pound's going to have more demand, market goes up. Don't get to the 50%, so retail sell. Sorry, institutional sell. Retail are getting in around this point because they now know the interest rates are going to go up. So institutional getting out, retail are getting in. These are monthlies. So we're selling off 3 months before we're even talking about the Scottish vote. So in the last few weeks that people have got all passionate and are making opinions about it. So again, that's why we're selling off, because we're at, 6-year highs against the dollars. 6 years high against the dollars. We've sold it for 3 months. It's nothing. Of course that was going to happen. So what you do is you've dragged them lines, as I said, down into your charts. So I would say that a monthly point of interest, it's here. Surprise, surprise, one of our lows. Monthly point of interest would then be here. Again, just plain line of sight. So you bring that through to your weeklies. Again, if you're seeing it weekly gaps or weekly points of interest, draw them in. Okay, weekly. That looks like a nice bit of support resistance here. Market's really pivoted around that. Go to your daily. Again, you've got a framework. Go to your hourlies. Brilliant. So I've got my higher time frame understanding. I've got a basic trend line. We're going up. Where's the market gone? Was there a significant move? Well, the last kind of real significant move, I'd say, with this candle here. Take that from the low to the high. Where's that 50%? 50% is here. Wow, quelle surprise. Recent day trading, we get to that 50%. We hold above the 38.2. We go on to make new highs from here. That's Fibonacci in action, guys. So how long did that take? Matter of seconds. Okay, guys, well, I think that's pretty much my time here on TradingPub. I'd like to thank Rolly, Yana, and Cam for inviting me here today. I hope you've enjoyed it. If there's any particular final questions? Okay, Steve
actually,
saying,
Actually, to tell you the truth,
Sorry,
Steve, you have another 20 minutes because we had allocated 75 minutes for your presentation.
75 minutes. Well, aren't you guys lucky? Well, that just goes to show that I should read. I should read what I was told. Sorry, guys. I'm just so used to doing 45 minutes to an hour. It's I just go into autopilot. Well, listen, absolute bonus here, guys. What we'll do is you tell me what products you want to go through, and we'll do it. We'll do it in real time. So tell me what products you trade, and I will show you my theories in real-time action. I'll show you basically how I'll do it raw, and then I'll show you examples of iView. I mean, this is a bonus 20 minutes where you can get involved, guys, and use this for real trade calls. Again, it's not financial advice, particular products. Let's do it. Okay, straight away, let's go on and look at some crude. Let's do it. This is the power of having a system like iView, because I'll show you how quick it is to tell you what crude's going to do. I feel like I'm on an infomercial here. I feel like I should be selling some knives or, the latest grade, chopping up a tin can with a knife. What have we got then? Let's do some crude. I don't know on this MetaTrader. Okay, I've got. I've got Brent. Well, do you want Brent or W? I'll do Brent. Okay, I don't have the crude on this right now, but Brent's going to give us a good indication. First of all, what I do is I was using iView in my standard way, and somebody asked me this. This is how quick it is. 3 charts, tile vertically, daily, template, hourly, template, 15-minute, template. So there we go. Straight away, this is my entire 14 years of trading there for you. So what have we got? We've got the daily view, the hourly view with the fibs, and the 15-minute. Okay, 15 minutes. Okay, so what can we see? We can see that crude is on a downward trend from the dailies. Okay, some big levels, weekly time, points of support and resistance being hit through the dailies. We've hit this daily weekly point of support down at 96.70. So below that, wow, nothing in the charts. So that was a good absolute low. Market then has found bidding activity and we've moved back up. We're not at the moving average yet, but we've closed inside the Bollinger Bands, lending me to say that really we might see a little bit of a bounce on the daily view and back to that moving average, back to 100, spot 16, which ties in with the moving average and is also a key psychological level. What do we need to know about oil? Well, we're not making any more of it, are we? It's inelastic demand. I was actually, one of my drivers has just bought a Tesla. So I was being driven by a Tesla on his last in London, and it was amazing. Absolutely no sound. Really quick, and again can go for hundreds and hundreds of miles on one charge. So let's face it, guys. Oil will be finished at some point, but right now, not many people are driving electric cars, and we're still massively, in a very archaic way, relying on fossil fuels. So oil in the short term is going nowhere. So it's always going to go up in the short term. So again, find these low points and buy. So what we need to do is interpret that view onto the hourlies. Well, time and time again, 50% fibs are working really well. So we see the market moves lower, but look how it bounces off these lower fibs. We haven't got to the lowest fib yet, so there could potentially still be some short-term down movement, even though, again, it looked like a bounce from the dailies. Like 50% of the market is dancing, and we're closing below it now. So I'd say, realistically, if we close below 98.98, a few more times and the market looks weak, then we're going to hit these lower fibs. Again, attack the lower ball, 98.03, 97.18, 95.81 in the short term. Okay, so what we're trying to do is build up a higher picture on your midterm and then maybe an entry point for your 15 minutes. So you're either going to be selling this 50% for these lower fibs to be hit, or you're anticipating the market moves lower in the short term and buying oil back based upon the fundamentals and the fact that the market should bounce back to that midpoint. Okay, so that's another way of looking at it. I mean, the 15 minutes, again, all you've got is your higher time frame points of interest. These short-term support and resistance levels here, then the market's going to try and head down to 96.70 or 100. So again, it depends how your view is. I mean, it's not really perfect for a risk reward, but maybe you're risking 40 ticks if you're going long to make 120, 130 ticks, okay? But then you don't want to risk 200 ticks in order to make 130 or 220 ticks. So it's that timing element. You might think that oil's going to go up, but maybe you don't want to be buying now, okay? Because it might be a little bit weaker in the short term. So you might want to buy it lower on these lower fibs. So it doesn't mean, again, I mean, you can be too greedy in trading. I can say that, yeah, I know it's going to go down in the short term, so I'm going to sell it and then buy it back. Try and pick one opinion. Say, well, I think actually we've hit a good low on the on oil, and I know it's in elastic demand, so I'm going to buy it. But don't buy it now. We're taking all this risk that in the short term it can go down to all these levels. Wait for it to come down. Don't be greedy. Wait for it to trade down here, these lower fib levels, and say, right, well, now I'll buy and get back to these higher levels. Okay, so wow, lots of questions coming through there. So that's just a quick idea of Brent, but again, we can use this on anything. So we just bring up back our market watch. So maybe we'll do the same on the S&P. There's something else people want to look at. So the S&P US 500. So this is how quick it is, guys. You just drag it across. So S&P. Don't think there's any, well, there's no doubt. If you listen to any of my webinars over the last 6 months, I said the S&P was absolutely 100% going to hit 2,000. Human curiosity, Okay, if the DAX has hit 10,000, you know, the NASDAQ and Dow is strong. There's too much curiosity out there to find out what's above 2,000 in the just to annoy George Soros. He's taken $2 billion worth of shorts. So getting George Soros squeezed out, that would be a major achievement. I'd love to see that. So again, market's very, very strong for the reasons I said. Institutional money doesn't know where else to put it. Okay, not going to put it in government bonds. Very unlikely to put it in currency. Put it in blue chips. You know, companies like Google have more money than countries. So where's your money safe? Not in government debt, in good old solid blue chip shares. So we can see again how the market is reacting very, very closely against this 50%. And again, we're starting to build new higher ranges. 2,000, distant memory. 2,000 is acting as support here, isn't it? 2,000. Again, this big move after the FOMC minutes last night. But the market, again, I'll tell you, I'll put it on a blank chart to show you. 50%. You know it's coming. So the 50%, let's take it from 2 hourly candles, just for argument's sake. From the absolute high to the absolute low. Where's that 50%? There it is. Market, again, doesn't really trade below it apart from maybe a tick. Consolidates, breaks through, makes new range. So what we're going to do? All together now, we're going to make a new high. So again, you don't really want to be getting long now because you're at the end of the move. So you might go up 26 ticks, 36 ticks, and then aggressively come back down. You want to be long from this 50%. That's your safety net. So any volatility can happen here, but as long as we don't get back to that 50%, you stay long, knowing we're going to make a new high. So I would say that I would be absolutely amazed if we don't break 211.04 and make a new high in the S&P. As long as we hold above this 23.6 and this 38.2. Yeah, that happens. Lean on me. We make a new high in the S&P. Might be one tick, but again, I would have bought down here around that 50%. So again, just putting the template back on. iView again is a little bit more kind of optimistic. The 50% is a little bit higher. So we're trading on the 50% now based upon my calculations. But again, look how the fib lines come into play. 261.8, major point of attraction. Next point of attraction, 161, then the 100, so the 50%. Okay, break above that and hold above it. Got these 2 extension points of the Fibonacci. So it's all about the market holding above the 50% and making new highs. So again, 40 ticks or so to make new highs, but you want to be getting involved really now or a little bit below. But once we start hitting these highs, guys, S&P doesn't make some fresh highs. 15-minute, again, just an idea to see what the market's doing. Do a Fibonacci on this. Where's the 50%? Hello, hello. There's the 50% on the 15-minute. Is that the low? Potentially. Markets hit the 50%, held above the 23.6, hitting the 23.6, so these highs are the new target. Time and time again, guys, 50% of that Fibonacci, you know, it's a real killer. And when you see it, and you see it being, you say to yourself, well, why don't I use Fibonacci all the time? Why doesn't everyone use Fibonacci? It works. It always works. It doesn't always work. It works 80% of the time. But you have to identify the strong directional move. If you don't, yeah, then you're always going to be on the back foot. You have to understand the Fibonacci from the perspective that it allows you to be confident to use it, but also understand that people like myself and other traders will use it in the right way with directional strong moves. Okay, so that again is the daily, hourly, 15-minute of the S&P. So again, new highs is what I'm calling here. What else are we looking at? Gold and silver. Gold's a great one. Okay, I've been quoting the Financial Times, not again to name drop too much, but what's the point of being a chief market strategist if you can't name drop? But yes, pretty much a year to the date, I said that by 2015, gold would hit $1,000. So I might be a little bit preemptive on that, but I tell you what, it's going to be closer to $1,000 than it is to 1900. So I predicted that a year back, and I think really gold's going to get a pummeling once we get below 1200. So it could still happen. So on gold, again, a very, very unique situation in gold at the minute. Okay, you can see your fib lines are up here. That is an indication that we're in a very, very strong bear market. The fact the market hasn't been able to retrace at all means the fib lines haven't redrawn. So the fib lines will redraw and change as the markets do on the hourlies, but they will only do it in certain criteria. So the market is so weak in gold, we haven't been able to redraw the fibs to find hourly value. So when we were below and closed by that 423 back here in the charts, sorry, back here in the charts, then that is a massive sell signal. Then we get to the weekly level, weekly, daily level, monthly level. You know, it's all becoming a bit too obvious, this, isn't it? Then where's it going to get to next? Well, the next big weekly, monthly level is 1182.20. So again, I predicted new highs in the S&P. Gold, once it gets below 1200, you are going to see a mighty drop, okay? Mighty drop down to these levels. And I would say, are we going to get to $1,000 by 2015? Well, I don't know, you see. Once it gets that momentum, it's not a million miles away, guys, is it? It's not out the question. But again, knowing these higher time frame points of interest and how the market reacts is amazing. Again, we don't know what happens in the future, but iView tells you, okay, we're below these levels here. So once again, we can't get back to these levels. It's going to get, we don't know anything in the future now, but look how it reacts. Yeah, sell below the moving average, break the lower Bollinger Band, we get to that daily, weekly level of support. So again, you can use these intraday, but you're getting, 80 tick moves, 200 tick moves. There's enough money to be made out of that on your hourly charts. So really for gold, what I'd say is we're consolidating towards the low end now. So we might see a little bit of relief. And I would say that the markets might get higher, but my view is gold is still going down. So what I would say is I wouldn't want to sell gold now, but I'd sell it at 1226.33, or this resistance points up here. So again, just look on the 15-minute charts. It's got the same levels running through because again, these monthly lines will run through all time frames. So let gold recover. But I'm happy. I'm happy to let gold spike up and recover 55 ticks, and I would sell as much as much. But I wouldn't sell it now. What's the point? There's no value selling it now. But is the value buying it to get 55 ticks? I don't know. But I wouldn't do that. My view is looking at the daily charts, bearish. Okay, hourly charts, bearish. How do I know? Fibonacci. Where's that strong directional move? It's here. That's a strong directional move. We haven't got back to the 50%. We're using the 38.2 as resistance. Close below the 23.6, gold makes a new low. Okay, that's it. That's real-time fibs in action. Okay, you've got the URL for the website there. Yeah, thanks for Yana to putting that up. What else would you like to see, guys? I think we've only really got a limited amount of time now, 5 minutes 40 actually. Any final products you'd like to go through? Any final thoughts on fibs? Bollinger Bands. Any final thoughts on technical analysis? Are you guys going to take any of these tools away? Are you going to go away, look for overextended moves, do a Fibonacci, use that 50%? Is that rang true to anybody? Is anybody interested in using these kind of techniques? How about sugar? Right. Okay. Well, again, it all depends on what you're trading. I mean, it works the same on equities as well. I mean, you want to look at. Let's look at. What have we got? See, I'm fairly limited because I'm only trading on a MetaTrader today, so it doesn't actually let me do certain commodities like sugar, and I don't know if we've got any individual equities, to be honest. No, we haven't got any individual equities, but it works, of course. It works on anything. Anything you can trade, it works on. So I've just demonstrated on 2 commodities and the S&P. So if you want to trade it on some currencies, dollar CAD, drag it across, see what it's telling you. Dollar CAD. Okay, hit the highs, coming back down. Where's that 50%? Well, in the hourlies, we close below it. So a new low in the dollar CAD is going to be 1.09265. So again, if you're looking for a good buying opportunity, maybe down here, or if you're looking for the market to overextend, then these are your levels. Again, so once we've hit a low in the 15-minute charts around about this daily level here, if you think that's going to be the low, then again, if that's the daily low here, and that's a good point of support, and we close above that, then we're getting back to the 50%, aren't we? Which ties in with the next daily level. So if you think that is the low in the dollar CAD now, then you start to buy a close above this level here and get back to your 50%. You've made yourself 25 ticks. Yeah, but if you carry on going lower, then you know the levels. The levels are down here. Yeah, lots of levels for it to hit. So we're going to see a massive, amount of weakness in the dollar CAD. Then your target is down here, 1.08962. So a short will give you 60 ticks. So maybe you put your 50% as your stop. So 24 ticks to sell down to make 62. Okay, a 3-to-1 risk-reward ratio. Happy days. Okay, again, it's having that framework and the confidence. Okay, guys. Well, I'm glad you enjoyed the presentation. I know there's lots of other good speakers coming up, lots of other guys in the industry that I know, and we all talk. It's quite a small community, so I hope you enjoy it. I'd like to thank Yana, Rolly, and Cam. I think again, if there's a good demand and a good response to this webinar, I'm certainly joining more events. Again, I do lots of webinars, probably 18, 20 webinars a month, on FX Street, Intertrader, and again, all my webinars are free. I don't charge for my education. All the products and my time. If you want my one-to-one sessions, they're £150 an hour, or you can get 3 for 100. Been very, very popular. I'm actually booked up until mid-October. So if you do want to take advantage of that and develop your own strategy with a professional trader and risk manager, do contact me. But again, guys, I'm not really here to, for a big sell. I demonstrate things that work, and I don't need, kind of extra credibility. I've got as much credibility as I need, to be honest, within the markets. And like I said, if you Google me, you can see that for yourself. All right, guys. Well, I think that's my time. It's been an absolute pleasure. Enjoy the rest of the speakers today, and I'll speak to you all soon. All right, guys. Thank you very much.
That's great. And thank you, Steve, for being with us this morning and kicking things off on such a positive note, and for giving us that terrific presentation, and particularly on how you use the RSI, the moving averages, Bollinger Bands, and Fibonacci tools to spot high-quality market entry and exit points. I particularly appreciated the time that you spent showing us and reminding us, if you will, how you use Fibonacci's and the 80-20 rule on retracements to the 50% level. My only regret is that I wish you had a little bit more enthusiasm around your trading techniques, but all kidding aside, thank you so much for your time, and I think we're all looking forward to the publication of your new book, and I think you said that was going to be available in the first quarter of 2015. So as a reminder, folks, I want to let you all know that all of our sessions are being recorded today, including the one we just held with Steve, and we're going to send them out to you in a follow-up email with a link to these recordings tomorrow afternoon to everyone that has registered for this event. So once again, I want to thank Steve for getting things kicked off. We are on time, and we have our next presenter in the queue. And Jared, if you can hear me, might be a good time to do a quick little mic check, and then to also, if you will, put up your first slide.